Specifically, the focus will be on trade and tariffs. There's a lot of other areas, of course, where there's also a lot of different policies that could be implemented. But of course, in the last few days, especially the trade war and the tariffs have played a very significant role, and we've got more detail than on many other policy fronts. So the idea is to take first a look at the areas of where policy changes might be coming, where we have the most detail about what those policy changes might look like. So the focus will, of course, be on what's been going on with tariffs, what have the implications been in terms of the changes to policy that has already been happening and what might be coming. And ultimately, of course, what does it mean in terms of what is the overall level of trade with Mexico, Canada, and China, and what could the implication be for GDP and for inflation. And finally, we'll have a very brief discussion of what does this then mean for financial markets? Most importantly, what does it mean for rates? And the backdrop, of course, to that debate is a discussion around what is the starting point for the economy if we think about these policies beginning over the next several months or several quarters. In other words, if the economy is strong and you add certain policies, then it will have some implications. If the economy is weak and you add the same policy, it will have some different implications. So if it is the case that we have already a strong economy and we add policies that could put some upward pressure, for example, on inflation, maybe put some upward pressure on GDP, then of course the starting point for where the economy is has some important implications for what does it mean for markets, and especially, of course, what does it mean for short-term interest rates. So with this agenda, let me first turn it over to Craig to talk about overview of new policies from the new administration.
Thanks, Torsten, and good morning, everyone. Thanks for having me. I know we're all very eager to hear Torsten's insights, so I'm going to try to move fairly quickly here. There's a lot we could cover, but I'd like to first just provide some framing around the various executive actions, including the recent news on tariffs, which I know everyone on this call is following closely. And then second, provide a high-level overview of the congressional agenda and point out a few things just to keep in mind as the administration and Congress try to advance their policy priorities. And of course, happy to drill down on anything during the Q&A. So big picture with respect to executive actions for this administration, in the near term, the administration is really focused on two things. One, getting its key personnel in place and confirmed by the Senate, which will take time, but they're making a lot of progress. And two, issuing these executive orders, which are coming out on a rolling basis. On the executive orders, the administration has certainly set a new bar in terms of the number of orders it's managed to issue over the first few weeks. It's been very impressive and shown that they're quite organized as they've come into the first few days in office. And the orders have covered a range of topics. That's from energy to immigration to digital assets to DEI to trade. But I would think about them in the context of a few buckets. First, there's reversing the Biden era orders. Many of these orders are symbolic. Things like DEI and climate might fall into this category. And it's very typical for a new administration to come in and reverse the previous administration's executive actions. Second are orders that give direction to agencies on what policies they should prioritize in these early days, and requesting that the agency come back to the White House with action items and reports to carry out the administration's wishes. So like digital assets is a good example there. But this is also very typical. They've included trade in that mix, which I think is coming back in April with some reports on how to handle USMCA and other issues. And then third, but not last, there's the subset of more aggressive orders, which are seeking to really explore the limits of the president's executive authority. And this would certainly include some of the tariff and immigration orders. Even the recent order on the sovereign wealth fund would probably fall into that category. I would make a note, this is not totally new. Biden certainly tested the legal limits of his executive authority. You can look at student loans as a good example there, which was ultimately struck down by the Supreme Court. So this has been in the offing through several administrations in terms of exploring the sort of limits of that power. On the issue of tariffs, just a few quick points to keep in mind. First, the key figures here President Trump in the room to help work through these big decisions around trade and tariff policy. Another important thing to keep in mind is the majority of tariff policy can be effectuated without Congress. So presidents have the significant power in this space under existing law and have been shown generally deference by the courts. In terms of President Trump's philosophy, he's been very clear that he's skeptical of the multilateral global trade order, an approach that's been championed over the past several decades through bodies like the WTO, and is looking to move towards a more bilateral kind of country by country approach. And I think he views tariffs both as a negotiation tool, but also part of his broader economic policy. So he can use it as leverage to get some concessions out of other countries on a range of his priorities. And I think in the case of Canada and Mexico, he's looking to address immigration and fentanyl, but he also wants to reorient the global economy towards a more domestic focus. And another important goal of the tariffs is to drive some revenue, which Republicans are hoping to point to help offset some of the other spending and tax cut priorities that they're hoping to enact. The last point I'll make on this would just be, what, if any, kind of limits apply here? I can think of 3 or 4. One would be the courts, very much an open question, and there's some novel and untested legal questions at play here, but generally courts have shown deference to the president on trade issues. Second would be Congress and just political pressure from key stakeholders. Still very early, but so far, I think the congressional leadership, Republican leadership, has given a lot of space for President Trump to push forward what his campaign promises and his priorities are, and we'll have to see how that plays out. But I would certainly keep an eye on border state members of Congress, and as well as some of the stakeholders that matter here, producers and farmers, which will be important voices as these policies take effect. And the other is markets and how the economy reacts to these policies, which I know Torsten will get into. So, and maybe a final point would just be the countries that are negotiating with Trump and how they react in countervailing actions. So we'll see how this all plays out over the coming weeks and what pain tolerance Trump and the administration has around pursuing some of these tariffs and the impact that it may or may not have on the economy. But I would just note that we're very much in the first inning here, and there's a lot more to come as they engage with other countries like China and Europe and renegotiate USMCA, et cetera. So just to pivot quickly to Congress, if we can put up the congressional slide that you'll see here. So all of these executive actions are occurring against this backdrop of a very busy and high stakes congressional schedule. And I think the slide on the screen was actually used at a House Republican retreat, but it gives you just a sense of how challenging the landscape is for lawmakers. And I would note, discount the timelines here as some of them are very aspirational and a bit unrealistic, but it shows you the sequencing, right? So first, you have to look at Congress needs to pass a budget resolution to kick off their approach to reconciliation. So in order to get to the decisions around tax and energy and immigration policy, they first have to pass a resolution laying out the top lines for how much they're willing to spend. The House was aiming to do that this week. It's been delayed. I think the leadership has had a difficult time balancing the competing views within the conference over how much deficit spending is appropriate and how to pay for some of their big policy ideas. But this is a really key part of the overall process that will eventually get you to this reconciliation bill that can be passed with a simple majority in both the House and Senate. The next thing that they need to juggle is government funding. So March 14th, it's coming up. It's a point of leverage, certainly, I think, for Democrats who typically Republicans have used Democratic votes to get government funding passed. Parts of their caucus are pretty skeptical of some of the funding deals. And so with the razor thin margin that exists in the House of Representatives right now, it's going to be a big challenge for Republicans as they try to work through this, while at the same time looking to pass this budget resolution and get the process started for reconciliation. The last thing I would note is the debt ceiling, which I'm sure you're all familiar with. The debt ceiling, this is of course a very bizarre mechanism here in the US that requires the government to occasionally pass legislation in order to pay for spending that's already incurred. When they hit that ceiling is a bit of a moving target, but it looks to be in the early summer. And that, of course, will be a major event if for any reason, we fail to raise the debt ceiling and get that taken care of. So I point out all of this because any one of these bills would be very difficult to handle on their own. But when you mix all of them together in and around the same time frame, along with the objectives of enacting this reconciliation bill with all of these important policies to the president, it's a tremendously difficult task. And the path ahead will certainly be challenging, many hard policy and political choices that will need to be made. And we should just anticipate some uncertainty in a very up and down process. If you look at how the Democrats approached the Inflation Reduction Act, that bill had died several times before it came back to life. And so that would not be unexpected in this environment as well. And we'll just have to see how they juggle all of these items under historically tight vote margins and competing deadlines. So with that, I will stop there and turn it over to Torsten for his insight.
Thanks so much. So as Craig just said, there's a number of different areas where policy changes might be coming. But the one area where we know, of course, policy changes have already taken place is, of course, trade. And what we just experienced last weekend with the tariffs, of course, is something that would potentially be quite important for the global economy. And just to set the stage for what's going on with global trade, this chart here shows you the blue areas are countries that in the year 2000 had most of their trade with the United States. And if you then go fast forward to 2020 and look at the same map, now see that countries in the world that have most of their trade with the United States, the blue areas, have shrunk quite significantly. Instead, the red areas or the red countries are countries that today now have most of their trade with China. So the entry of China into WTO in 2000 has played a very, very important role in the global economy, whereby the vast majority of countries in the world now trade more with China than they trade with the US. So this is, of course, important when we think about what is the backdrop for a lot of the decisions that not only the United States, but politicians around the world are taking at the moment, because China is simply becoming more and more important when it comes to global trade. Looking specifically at the US and at what share of US imports in the bar to the left comes from China and Mexico and Canada relative to others, and looking in the bar to the right, what share of US exports go to Canada, China, and Mexico relative to others. And as you can see in the chart, in very round numbers, roughly 45% of US imports and US exports are with Canada, China, and Mexico. And why is that important? Well, that's of course very important because if we do begin to impose 25% tariffs on Canada and on Mexico and 10% on China, we can begin to go back and then calculate what might that mean for GDP, and we can begin to calculate what might that therefore mean for overall trade. So the first obvious conclusion is that when something makes up 45% of the total, it obviously is a very significant share and therefore something that could potentially have important implications. Taking, for example, imports. So imports as a share of GDP in very round numbers is around 10% in the US. And if we now have in very round numbers that roughly half of trade imports is with Canada, China, and Mexico, that basically means that roughly 5% of US GDP would be directly impacted if we were to see 25% tariffs on Canada and Mexico and 10% on China. Of course, we now know that we now have a 30-day waiting period. We'll have to wait and see exactly what will happen when we get to 30 days time in terms of Canada and Mexico. But we do, of course, know now that China did experience now 10% tariffs. So we can then look at that from this chart and again come to the conclusion, what does that then mean for GDP? And again, the dark blue area there, of course, shows you that with China still making up a decent share of imports and a decent share of exports, this is, of course,